We work seamlessly together. We work seamlessly together. Stuart handles the closing, the title, and all of that. We handle the 1031 exchange component. I'm excited to bring you great information that you can use in the marketplace. At the end of the day, Stewart is committed to giving you resources and tools that can help you and your clients put more deals together. And the 1031 exchange is certainly a really powerful tool that can help out your investor clients. And we're going to go through that. We'll discuss the basics. Quick background on myself, and I'm going to make it in less than 30 seconds. I've been doing exchanges since 1988, so 35 plus years in this business exclusively. I'm a former president of our National Trade Association, on the board for 6 years. I've contributed to numerous books and hundreds of articles on this topic. So I can't give you tax or legal advice, right? So here's my disclaimer. We're discussing concepts. You and your clients are always going to want to run their specific situation by their tax and legal advisors. But we're going to discuss a whole lot of concepts today, and I'm going to pack a lot into a short presentation. Please feel free. I'll leave my contact information at the end. Welcome calls, inquiries, anything that wasn't clear, and I'll do some Q&A at the end, and I'll keep an eye on the chat as we go along too. So 1031 exchanges are called that because they come from a section of the tax code, section 1031. Believe it or not, this has been in the tax code since 1921. So we're talking 103 years. It's been around longer than the home interest tax benefit. So it's a valuable part. Here's what it allows. Section 1031 says any owner that holds a property for investment purposes or uses it in their business, either one, can exchange that property and defer paying all capital gain taxes if they exchange it for another, what we call like kind property held for investment or used in their business. From a practical perspective, this is the way real estate investors build wealth in real estate. They have one rental house. They do an exchange out of that and they buy two. They come out of two rental houses and they get four, and maybe they get eight, and then they go into an apartment complex. I read just recently, you may not know this, but Arnold Schwarzenegger, he has a $300 million real estate portfolio. And it all started with one sixplex he bought in Los Angeles that he exchanged for a 24 unit building, for a 60 unit building. And that is how he built his portfolio, is by using Section 1031. So commercial investors, we do a lot of residential transactions. And we're going to talk a lot about vacation homes and second homes held for investment in planning opportunities. And at the very end, I'm going to talk about the integration between Section 121 and Section 1031, ways that you can convert a rental to a residence and vice versa. So it's a powerful strategy that helps your clients defer taxes. When they defer taxes, you as a real estate professional, you help them defer taxes. They have to redeploy that money. So you a lot of times get a very motivated buyer that is working with you to purchase property. And because they've deferred all the taxes, here's the beauty of it, they can buy a larger property than they could have without doing tax deferral. So on the most simplistic aspect on this next slide here, if we just look at a typical taxable sale, you just take a property, you close, and you receive back cash. So it's property given up for cash. In a 1031 exchange, we transfer property held for investment or used in a business for other property held for investment or used in a business. That's all it is. Now we're going to go through time requirements and different things that are involved with the process with that. But it's really pretty straightforward at the most basic level. And I'm going to kind of unpack how you do the most common variation here, which is a delayed exchange. Now, the reason why we do an exchange is pretty obvious. We want to defer capital gain taxes. Now, I know in Florida, you don't have a state tax, which means a lot of people are relocating there because you've got such a great business environment. By the way, I mentioned earlier to Rhonda, I actually own an investment property in Florida. So I'm very much invested and believe in that state's economy and that it's a great investment market. But you defer capital gain taxes. But here's a common question that we get asked. What is the capital gain tax rate? Right? And unfortunately, as you'll see on the screen here, it's a little bit more nuanced than what is the actual rate. There are four potential taxes that someone would pay. So the highest tax is depreciation recapture, which is taxed at 25%. If you've owned, let's say, a single family home for 15 years, and every year you've taken that depreciation on your tax return, if you don't do an exchange and you sell it, you're going to have to pay taxes on all that recaptured depreciation at a rate of 25%. Then the remaining federal gain depends upon your taxable income. You'll be taxed at either a 15 or 20% bracket. But one thing I want to point out that sometimes people don't consider, if you don't do an exchange, all that money could push you up into the higher tax bracket. So you could very well be facing that 20% federal capital gain rate. You've got this other tax called a net investment income tax. This was put in the code back in 2010. Any net investment income, which capital gain is considered net investment income, over 200,000 for a single filer, is taxed at an additional 3.8%. If you're married and you file jointly, anything over 250,000 faces this additional 3.8% tax. Now you'll see state taxes. And by the way, I got a typo there. California, which is the old 13.3% rate, they just bumped up their state tax rate to 14.4%. If I were to pick an average state tax in America, you're probably looking at somewhere 5, 6, 7%, fairly typical. So any of your clients that are coming in from maybe the Northeast or the colder states, they might very well be facing that state sales tax. So if you're going to do a taxable sale, you got to look at all these taxes. And what we find is a lot of times when people see what they're going to have to write as a check, they're left with very little money to redeploy. They have very little left over after they pay all the taxes. The exchange is going to be the solution to that. And you'll know enough after this presentation to know the basics and to help your clients out with that. So that's the reason why we do it. Now, here's the code, and I'm just going to read it. I won't do a lot of legalese, but this is the tax code. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or investment. So a real important takeaway in the first line there. No gain or loss shall be recognized. So we call this non-recognition treatment. Sometimes, Melissa, yep, we'll be able to get the recording. Yep, you will be able to get the recording. I know Stuart will get that out, or you can request it with your local Stuart BDO. So it's not a tax-free exchange, it's a tax-deferred exchange. You're pushing the tax liability into the future. Well, then that probably begs the question, well, if I'm going to have to pay the taxes anyway, why don't I just pay the taxes now, get it over with? Because the odds are tax rates aren't going down. They're probably going to go up in the future. And here's kind of the reason why that analysis really doesn't apply. When you do an exchange, you can exchange over and over and over again. There's nothing that says you have to pay your taxes as long as you keep holding for investment and you acquire another like-kind property. You can do an unlimited number of 1031 exchanges. And here's where it's a powerful tool. Let's say your client starts with a little single family home and they build up a large portfolio by exchanging. When they pass away, their heirs get it with what we call a full step up in basis to the fair market value at the time the property is inherited. So you start with, say, $100,000 property and you build up a $5 million portfolio. Your heirs get it with a value of 5 million, meaning you didn't pay capital gain taxes because you're doing exchanges throughout your lifetime, and neither do your heirs have to pay capital gain taxes. So tremendous tool. We're going to unpack what like-kind property is all about and look into that in a few moments. You're going to see it really encompasses so much that qualifies as like-kind property. Very, very broad. Now, some things you can't exchange. I want to focus on the first bullet point and the fourth one. The first one is what we call stock in trade or other property held primarily for sale. So if the intent is to hold a property for sale purposes, let's say it's new development or maybe a fix and flip or something like that, that property is excluded. You cannot do an exchange on any property where the intent is to sell it, hold it for sale, versus holding it for long-term investment. And for anything besides bare land, we consider long-term investment holding for rental income. So you can't do an exchange on those types of properties. Now, a little caveat on that. Somebody that does fix and flips or holds for sale or development, they can't do an exchange on their development or their sale property, but they certainly could form another LLC that holds property for a long-term investment, and they can do an exchange on those assets. So in a way, they kind of separate over. These are the development held for sale activities, and over here are the properties that are being held for long-term investment that do qualify. Now let's talk about the fourth bullet point, because many investors hold title in what? Partnerships and LLCs for liability protection. So any entity up at the entity level can do a 1031 exchange. A partnership can sell to a buyer, and the entire partnership can buy a replacement property. An S corp can do that, an individual, a trust, a C corp. So if the entity sells and acquires, that's absolutely allowed. Where things get a little more challenging is where you've got different partners in a partnership. So let's just make it simple. Three partners, each one owns 1/3 of that property in a partnership. The code says you cannot do an exchange on a partnership interest. The partnership owns real property. My 1/3 partnership interest is really a personal property interest in an entity that owns real property. And many of you probably know a few years ago, personal property exchanges were taken out of the tax code. Only real estate, or what we call real property, qualifies. So there are some planning opportunities there, and I'm not going to get into the weeds of it. If your clients hold title in a partnership or LLC, and you have a pretty good idea, some want to exchange and other ones want to sell out, you can certainly give a call and we can kind of go through some options. There are different strategies. One's called a swap and drop, another one's a drop and swap. And these are approaches to get it out of that partnership, basically have the partnership deed out of the partnership to the three former partners. So now they're tenant and common owners. When they go to close on the property, and hopefully everyone here is using the closers at Stewart, or if you haven't, try them out on your next transaction. When they close, the one person that wants the cash gets their cash, pays the taxes. The two others that want to exchange do like kind exchanges and do other property. So it gets a little bit complicated. If you run into that with an LLC or partnership, certainly reach out and we can review those options. Now, this is something that we get a lot of questions on, which is how long do I have to hold a property before it's considered held for investment? And the reality is, there's no set time period anywhere in the tax code. Some people have heard you've got to hold it for 1 year or a year and a day or 2 years. And that's not accurate. What you see on this screen is that the IRS is really going to look at the subjective intent of the taxpayer. What do they intend to do? And then they're going to look at all of their facts and circumstances. So the amount of time that you hold it, certainly that's a variable, but they're going to look at other variables. So let me kind of give you an example to illustrate the point that has nothing to do with real estate. Let's say I woke up this morning and I intended to be very healthy today. So I intended to go for some cardio first thing in the morning, eat a very healthy breakfast, and then I intended to lift weights. So cardio, healthy eating, weightlifting, right? Weight training. Let's say instead of doing that, even though that was my intent, let's say I got out of bed, I didn't do any exercise. I had 5 cups of coffee and I ran over to McDonald's and grabbed 3 Egg McMuffins, scarfed them down. And now I've decided my day that I'm too busy to do any working out. So my intent might have been to be healthy, but the IRS is going to look at my actual actions. Okay. I ate lousy food and I didn't exercise. The same thing applies to real estate. The IRS is going to look at provable objective factors. So if you have a lot of those factors in your favor, that's much better. If you don't have many, then that's not going to be as good. So there's not a mandatory 1 year holding period at all. In fact, the case on the very bottom, Riesing versus Commissioner, is a tax court decision where somebody only held a property for 8 months and yet it qualified. So again, you got to look at your unique facts and circumstances on that and to do that. So I see a question coming in. I'm going to answer it from Justina. Does 1031 exchange, can it be done with a primary residence? And the answer to that, Justina, is no. It only qualifies to property held for investment. But let me give you a caveat there. If you convert property you live in into a rental property, then you can do an exchange. So I've got a whole section at the end where I'm going to kind of flesh this out in more detail, but you cannot, if you live in it as your principal residence, it won't qualify, but you can convert it from a residence into a property held for investment, and then it will qualify. So we'll flesh that out. Now I'm going to make this really simple. We call this the exchange equation. These are the things that you need to keep in mind if you want your clients to have 100% tax deferral. So for full tax deferral, just have to meet two simple requirements. Number one, you want to reinvest all of the net exchange proceeds. So the net would be after your commission, after Stewart's closing fees, recording fees, etc. It's the net equity, not the gross sales price. If you receive any proceeds, and you certainly can, those are called cash boot. So any money you take out is called cash boot. The other one is you want to acquire property with the same or a greater amount of debt. And the easy way to look at that is you just look at the mortgage payoff on the settlement statement. If I have a mortgage payoff of 100,000, I need to have 100,000 or more of mortgage on one or more replacement properties. If I go down in mortgage, let's say I'm from 100,000 to 80, I have $20,000 of mortgage boot. So to recap, look at your settlement statement. You're going to look at the net proceeds. That's what has to be reinvested for full deferral. You look at the mortgage payoff. You need to have that amount of mortgage or more on what you buy. And just to let you know, many of our clients, in fact, nationally, about 1/3 of all 1031 exchange investors do partially deferred exchanges. So they take some money out or they go down in mortgage. So don't think that it's an all or nothing proposition. Many people choose to do a partially deferred exchange, get a lot of the benefits. So let me walk you through a few examples here to illustrate it. Property here is being sold for 900,000. Mortgage payoff 300,000. The cost of sale, your real estate commissions, stewards fees, etc., 60,000, leaving net equity of 540. This person's going to go up in value. They're buying for 1.2 million. The debt goes from 300,000 to 660, so there's no mortgage boot. They reinvest all of their net equity. This is an example of a fully deferred exchange, no taxes owed at all. Now, let me show you one where it's a partially deferred exchange. So same sales price, but the debt goes from 300,000 down to 260. So there's 40,000 of mortgage boot. This taxpayer puts $100,000 in their pocket. So there's 100,000 of cash boot. We add the 40,000 mortgage boot to the 100,000 cash boot, getting $140,000 total boot. Now, one little caveat with this, when we call it boot, most of the time it's taxable or it's potentially taxable. However, your client may have other factors that would not make it taxable. For example, there's something called suspended carry forward losses that we can use to offset boot. So again, it really drives home why it's important to talk to your tax advisor, your CPA, because everybody's situation is totally different. Joshua has a question here. We discussed the limits on types of buyer, arm's length relative. Joshua, great question. Let me address that now. Anybody can buy the property. So as long as it's a buyer coming in and buying the property, they can buy that. So you can sell a property to a family member or somebody who's related. However, there's a flip side of that. If you're dealing with a related party, like a family member, there are restrictions on buying from family members in a 1031 exchange. So I don't have the slide on that, but you can sell to related parties. Where it gets tricky is purchasing from related parties. Lindsay's got a good question. I think I'm just going to kind of take them. I want to make this interactive for everybody. If a seller has an investment property with no debt, they bought for all cash, the net exchange would be a tax, would be the sales price, not the sales price minus. Oh, okay. Lindsay. Yeah, what you're looking at is there are two different calculations here. There's one thing you want to do if you're going to sell and pay taxes. there's a calculation to determine your capital gain. Here's the formula for that. Purchase price plus improvements minus depreciation gives you your net adjusted basis. So it's what I paid for it. I add up all my improvements. I subtract out my depreciation. That equals my net adjusted basis. To determine my gain, I take today's sales price minus closing costs minus net adjusted basis. That gives me the capital gain. And that's what I'll have to pay taxes on. Then you have to dissect that into those 4 different levels of taxes to see what will be owed. If you don't want to pay any taxes, the rules are very, very simple. Number 1, reinvest all the net equity. Number 2, have the same or greater amount of debt. So you don't have to worry about the basis of the property if they're doing a 100% deferred exchange. Hopefully that makes sense to you there. So I just wanted to tell you, this makes it really easy of kind of what you need to accomplish. Josh had a great question. Is API the qualified intermediary? Yes, we are. So we are owned by Stewart. We're a wholly owned subsidiary, and we work closely with Stewart Title closing their transactions. So because we're all part of the same company, it's very, very easy putting together a seamless transaction for you and your customers. So yes, API is a qualified intermediary. All right, let me go on here and get into the different variations. So you can do a 2-party swap. They rarely happen. The one that I want to focus most of the time on is the 3rd bullet point, a delayed exchange with a qualified intermediary. About 97% of all exchanges are this variation. And we'll get into that after I get into like-kind property. And I want to talk about this because we've got some unique things in Florida with second and vacation homes. So like-kind property is very, very broad. It's any property held for investment or used in a business. So look at this slide. You can exchange ranch land for an apartment building or for industrial, an office, a vineyard, etc. It's very broad. Probably an easier way to look at it is to see what's excluded. So the types of property you cannot do a 1031 exchange on are the first 2 bullet points there. You cannot do a 1031 exchange on the house you live in, and you cannot do an exchange on property that's held for sale, what we call dealer property. Other than that, as long as it's real estate held for investment or used in a business, you can exchange it for any other property held for investment or used in a business. So at the very last bullet point, look at how broad it is. You can exchange bare land directly into a commercial building. You can exchange a single family rental for a larger multifamily property. You can exchange for office, industrial. A lot of different types of easements qualify. An agricultural easement can qualify. A conservation easement. We even do something called perpetual communication easements, which are cell towers. In certain parts of the country, air rights and water rights qualify. So in Colorado, where I'm speaking to you, water rights are considered real property. So typically in the drier western states, places like Colorado, New Mexico, Arizona, Nevada, etc., water rights are considered real estate. We'll get into the vacation homes. And there's another one there called fractional ownership that is another planning opportunity. Bill had a great question. How does exchanging 2 properties for 1 work? So, Bill, that's a great question. Let me unpack that here for you. And hopefully, you guys like this format where I'm taking your questions as we go along. If you want to go at the end, I can do that as well. If you look at 2 properties, you want to look at the combined net equity and the combined debt, and make sure if you want full deferral that gets rolled into that one replacement property. But there's one little caveat, Bill. When you're selling 2 properties as part of the same exchange, whichever property closes first begins the 45-day and 180-day time deadline for the entire transaction. So what you want to do practically is get property number 1 under contract, push back the closing date. Don't close it right away. With property number 2, maybe you drop the sales price so you get it under contract and it closes right around the same time. So we can do that with 2 properties. We can sell 3 into 1. There are a lot of different options that are available to you to accomplish that. So I'm going to go through quickly a few things. I already mentioned air rights. This would be like in New York City. You've got the right to develop above your building. It's literally air. It's a transferable development right. That's considered real property, and you can exchange it for a fee interest. All types of easements qualify, but we do lots of cell towers in a 1031 exchange. We did a conservation easement deal here in Colorado where the town of Boulder picked up 300 acres of land in a conservation easement, and the person sold that in a 1031 exchange and went into apartment buildings. So, depending upon your needs, these are some things that you maybe haven't thought of. Even oil, gas, and mineral rights, energy can qualify. You've got to do a royalty interest, not a production payment. But if you want to diversify, that's another planning opportunity. Now, what I want to do is spend a little time talking about second homes, vacation homes, because it comes up. And before I do that, I'll take Patty's question. Can you exchange into a residential property that has a house on it that I would live in, but it has a multi-buy warehouse on the property that's rented out? Patty, excellent question. This is what we call a split transaction. You're buying one property with two different uses. One's a house, over here is a warehouse. So the portion of the property that is the warehouse, if you rent it out, will qualify. But you have to pull out the portion of the house that is the residential property that you're living in. You can't exchange into something you're going to live in. It's got to be only property held for investment. So in that one, you'd want to make sure the value of that warehouse and the land meets your exchange requirements. There are some good questions coming in here. Melissa's got a great one, and I'm going to actually have a question on that. I'm going to address that a little bit later. Joshua said, are there any restrictions to the type of financing you do debt to match it? Would seller financing are subject to? Debt is debt, Joshua. Good question. So it could be conventional loan. It could be a DSCR loan, what's known as non-QM financing. It could be a subject to, or it could be seller financing. Debt is debt, regardless of whether it's a traditional lender or not. All right, let me spend some time on vacation homes. So let me give you the bad news first, then I'll give you the good news. Bad news. If the property is a pure vacation home, it's never been rented, personal use, it will not qualify in an exchange. So you can't do an exchange on a pure second home with zero rental income. It doesn't work. However, back in 2008, the IRS created guidance. This is called a safe harbor, which is really what it sounds like. If you stay within these parameters, you're safe, and the IRS will allow the exchange to go forth. So they came up with a safe harbor and said, if you meet these requirements, we consider it a property held for investment purposes. And here's something you can do. So I gave you the bad news first. You could have somebody with a pure second home, they can convert it to a property held for investment that meets these requirements. So they've owned it, second home, for 20 years. Now, for the next 2 years, they convert it into a qualifying investment property. Here's what they need to do. And if you want to remember this, the really easy way I think to remember this is I like to call this the rule of twos. So, first one is you've got to hold it for 2 years. Number two, within each year, you have to have 2 weeks of rental income. That's pretty easy to accomplish in Florida. You probably have half the year where there's a lot of demand. And if you look at the third bullet point down under requirements, you can even rent to a family member as long as you rent it at fair market value. So you could rent it to your brothers, your sisters, aunts, uncles, as long as they're paying fair market rent. The third requirement is you can't have more than 2 weeks of personal use or 10% of the time it's rented. So that's the one that trips people up. And they go, well, wait a minute, I want to use my property for a month. What I tell them is, we'll just use your property for 2 weeks, lease somebody else's property, and do that. So let me recap it. To qualify as a property held for investment, you've got to hold it for 2 years. You have to rent it for 2 weeks in each year, and your personal use cannot go over 2 weeks or 10% of the time it's rented. Hey, Joshua, thanks for that comment there. I appreciate that. Well, the reality is we do a lot of this, and I will tell you at the end, you can always pick my brain for free. We've got a whole staff of experienced people, and this is all we do is help people out. So I think the vacation home is a really good planning opportunity. You might have people that are snowbirds that pick up a property now, they rent it out for a few seasons, so it qualifies in an exchange, and later on they're going to move into it, and we'll talk about that. Let me give you kind of the little foreshadowing on that. The IRS says you can change your intent with the property. So if I intend to hold it for investment for a couple of years, and after 2 years are up, I change my mind, and now I want to live in it, that's 100% permitted. So as long as you meet this revenue procedure and follow these requirements, it absolutely qualifies. Does owner-occupied multifamily property qualify? Was a question that came in. Let me give you the answer. The owner-occupied, only the parts that you rent out. So if I have a fourplex and I live in one unit, the 3 rental units qualify. From Joshua, if it's greater than 14 days or 10%, can you just visit as owner for a month as long as it's rented for 10 months? Yes. If it's rented for 10 months, you get 2 weeks or 10% of the time it's rented. I just find a lot of times people don't necessarily have it rented for that long of a time. They may rent it for 2 weeks at a time or a few months, but that is potentially possible. Um, Question from Marion: Can a non-U.S. citizen use the 1031 exchange? We do. That one gets a little complicated. It depends on where they're filing taxes. So normally, a Canadian citizen is going to be subject to the laws, tax laws of Canada, not the U.S. Now we do foreign exchanges for U.S. citizens. We can do foreign for foreign property. Generally, like kind has to be domestic for other domestic property. I'm going to move on here. I got quite a few slides to go. I'll be happy to take more questions at the end. One last thing I want to mention, particularly if you're dealing with people that are retiring or nearing retirement age, is this whole concept of fractional ownership. These are people that exchange into a piece of a larger commercial building with a lot of co-owners. Could be an apartment complex, maybe a medical office. These were done 20 years ago as tenant in common structures. Today, most of these are done in what's known as a DST, a Delaware Statutory Trust. The big advantage is you're able to go passive. So people that are tired of maintaining their homes, their single family homes, and taking care of them, they want to offload that. They can go into a relatively passive investment with these Delaware Statutory Trusts. The risks, you got to look at this like you would any other investment, right? You're going into a piece of property. You're not buying an income stream. You're buying a piece of real estate. You want to look at the tenants. You want to look at the rent escalations. You want to look at the experience of the sponsor. Are they new or have they been doing this for a long time? You want to look at their capitalization. Do they have sufficient reserves to do tenant improvements, TIs? Have they weathered a downturn? Do they have a good structure in place? So there are a lot of questions to ask. These, by the way, are only sold to what are known as accredited investors. So you have to meet the definition of being an accredited investor to get access to these types of opportunities. Now, I already gave you the preview of the different types. We're going to get into the most common one is the delayed exchange. So here's where it starts. Up top is the taxpayer. That's the real estate investor. I just use that because I talk to a lot of CPAs and attorneys. Step number one, as soon as the property you're selling is under contract, so you've got it under contract, you've opened up an order with Stewart locally, give us a call. We will prepare the 1031 documents. You cannot set up an exchange after the property's closed. You can't go back after the fact and set up an exchange. Unfortunately, we get a lot of questions every month with people that closed, didn't set up the 1031 exchange, and now they realize they have a big tax hit. So always set it up, got to be set up prior to closing. The asset preservation, we're the qualified intermediary. Sometimes you'll hear us called a QI, an intermediary, a facilitator, an accommodator. Those are all synonymous terms. We now, through an assignment of the contract, we step into the shoes, we become the seller of the property. So we sell the property to the buyer. We instruct the steward closer to directly deed it to the buyer. And then the money comes to us as the qualified intermediary. Now you work with your client on what you want to purchase. They make offers, they get it under contract. We prepare paperwork, and we're now assigned in as a buyer. So we take the money we're holding, we purchase the replacement property, and we instruct the steward closer to directly deed it back. So when you look at what's going on, the qualified intermediary sells the relinquished property, the qualified intermediary buys the replacement property. The investor is just giving up title to a property and receiving title back. That's just the transfer of title. Now we're going to get into the time requirements in a moment, Um, these time requirements apply to when the property closes. So some people wonder, is it when we sign the contract? It's only when you actually close on the property that these time requirements apply. So day zero is the closing date. We then have a 45-day identification period. Now there are 45 calendar days. They're going to go through weekends. They're going to go through holidays. If your 45th day is on Christmas, you want to get the identification done before that. So you have 45 days to identify. You then have another 135 days to close on property that's been identified. So we call that first the identification period. The 180 days is what we call the exchange period. Now you'll notice it's a maximum of 180 days or the date that the taxpayer must file its tax return, whichever is earlier. So anybody that closes right around the middle of October, if they file their taxes on April 15th, they could potentially have less time because if they file their taxes, they shorten their 180-day period. What they would want to do is this: file an extension, close their exchange in 180 days, then go ahead and file their tax return. That's really what they'd want to do in that sort of a scenario. Um, from Joshua, does the filing date include any filed extensions? It's actually when you file your taxes, Joshua. So I'm saying if I close, let's say I closed on December 29th and I file my taxes on April 15th. If I file my taxes, then that's the end of my exchange period. If I file an extension, which gives me until October 15th for individuals, then I've got the 180-day period. So the best approach is if you close in the last 3 months of the year, file an extension, close on your property within 180 days, and then go ahead and file your tax return. That's the best way to do that. And by the way, you don't have to keep track of these. As a qualified intermediary, when you close, we're going to provide your client the 45 days, the 180 days. We're going to provide a summary of how they identify, and I'll be discussing that next. So we try to make this process very user friendly. At Stewart, we're committed to making a transaction not only efficient, but one that's easy for the client, right? Where we just lay it out and make this as easy for everybody as possible. Now, there's some different ways to identify, and you'll see on this next slide, I've got 3 different identification rules. Let me answer your question. Does the tax filing extension need to be filed before the first closing, or is that independent? So Joshua, let me be clear. You only need to file an extension if you're closing in the last few months of the year, anywhere after October 15th, and you file your taxes on April 15th. Anybody closing before then just gets 180 days. Now, the extension needs to be filed, right? If I don't file an extension, then I don't have an extension. All you do is call up your tax advisor, say, please file an extension. That's all I do is I've been filing extensions for my whole adult life. I never filed taxes on the 15th. But you have to have it filed. You can't just prepare it. You actually have to file the extension, if that makes sense. And Joshua, if you're not clear on this, I'd be happy offline to unpack this a little bit more for you. But for most people, 45 days, maximum of 180. Going back to the identification rules here, 3 different rules. The first one I'm going to cover is the most popular. The 200% rule is the second most popular. 95% rule is rarely used. So let's go under the 3 property rule. Under the 3 property rule, the taxpayer can identify 3 properties of any fair market value. So let's say they sell for $1 million. They identify one at $1 million, one at $2 million, one at $5 million. You're limited in number to 3, but the value's unlimited. So it doesn't matter the value, but you're limited to 3. If somebody wants to identify more than 3, then they can use the 200% rule. This is you can identify an unlimited number of properties, but the value is capped at twice what you sold. So 200%. So if I sell for $1 million, I can identify as many properties as I want, but not over $2 million in value. So 3 property rule to summarize: 3 properties, any value, or alternatively, kind of the inverse, an unlimited number of properties, but then I'm capped at no more than twice the gross value, the fair market value of what I sold. Now, there's one last rule, and It's called the 95% rule. If you identify more than 3 and more than 200%, you have to close on 95% of the values of the properties identified. Very, very tough to do that. And that's why I don't spend much time on it. It's just rarely happens. Now, how do you identify? First off, you've got to do it in writing. You can't just orally identify. You've got to write in writing, sign the data by the taxpayer. The second one's important. It must unambiguously describe the property. So unambiguous means it's clear what it is. It's going to be a street address. I'm identifying 379 Main Street. I'm not identifying a 3-bedroom, 2-bath house. If it's a condo, I'm not identifying a unit along the shore in new development. I have to identify unit 45, unit 82, specific properties. This is to be signed to data by the taxpayer, sent by midnight. That's the cutoff of the 45th day, and that's generally sent to the qualified intermediary. By the way, Bill had a good question. He said, you talked about 2 for 1. What about 1 for 2? So, Bill, probably more common is somebody selling one property and buying multiple. So I can sell one and I could buy 2. I could sell 1 and buy 3. Years ago, I did an exchange where I sold 1 property and I exchanged into 5 replacement properties. Last year, I sold 1 in Arizona and I exchanged into 4 in Missouri, 1 in Tennessee. So absolutely, it doesn't have to be sell 1, buy 1. All that I have to look at is what's my net equity? Did I redeploy that? Number 2, what's my mortgage payoff? Did I have that amount or more of mortgage? And then I've obviously got to meet these identification rules. So thanks for that question there. That's a good one. So this is how you identify property. Again, we will provide a form for you to do that to make it easier so you can identify property. Now, some things not to do. I just want to talk about the last one here, Dobrik versus Commissioner. Somebody backdated their identification. They submitted it to the IRS as if they did it properly, audited them. And what it is, plain and simple, it's tax fraud. In Dobrik versus Commissioner, they backdated their identification notice. They got hit with having to pay their capital gain taxes, $2.2 million, plus a 75% fraud penalty. So they had to pay another 1.6 million in fraud plus interest. So the point is, you've got these rules that are there. They allow all these opportunities, but make sure you follow the rules. There's no wiggle room. There's no ambiguity. Stay within the rules that the IRS allows, and you're absolutely good to defer taxes over and over and over again. Don't follow the rules and you're at considerable risk. Now, I'm not going to unpack all these, but I want to talk about what we call parking arrangements. These are creative strategies. So one parking arrangement is a reverse exchange. We buy the new property before we sell the existing one. So we close on the purchase before having 180 days to do the sale. An improvement exchange is building a brand new property from the ground up or refurbishing one. And then a reverse improvement is buying the dirt, constructing a new building while still owning your existing property. A lot of owner users do a reverse improvement exchange. You can't stop operating your business for 6 months or you'll go bankrupt. So we did one, we're doing actually a little while back in Colorado. It's a feed supply company where they moved their building closer to the interstate so they had better access. The building's 4 times the size of the original building, so it's bigger. They can make more money, but they can't stop their operations. So we did a reverse improvement, bought the land, started improving the new property, and then later they sold their existing property. So these are out there. Most of the time, you're not going to get into these. What I want to do now is go down this route. I think this is going to be really applicable. Section 1031 deals with any property held for investment, and it's tax deferral. So the basis just rolls over and over. 121, Section 121 is the provision most of you are familiar with. You live in a property 2 out of 5 years, you exclude $250,000 if you're single, $500,000 if you're married. This is tax exclusion. It's better than an exchange because you get to put the money in your pocket. One quick caveat, just to give you a heads up, because I get involved on legislative issues. The National Association of Realtors is working with people in Congress. They would like to double these limits. These limits came about back in 1997. Properties have gone up a lot. So $250,000 for a single filer doesn't exclude a lot of gain because properties have gone up tremendously. So They do have support. It hasn't been proposed yet in a bill, but they would like to propose doubling the amount. So 500,000 for single filer, 1 million married filing jointly. Just want to pass that one on there. Let me check a chat question. I haven't, Cheryl, I have an investor who wants to use a 1030. 1035 is something entirely different. You're not dealing with real estate. There are other provisions that deal with other things, life insurance policies. Section 1033 deals with involuntary conversion. Section 721 deals with what's called an UPREIT transaction, contributing to your property for OP units. So there are other provisions of the tax code. Cheryl, if you'd like to at the end, reach out to me. I'd be happy to give you more. But the tax code has all sorts of provisions. What most people do in real estate is they use Section 1031. So I want to give you some of the options here. 1031, property held for investment. 121, you live in it. And what I want to do is talk about different scenarios. I think everybody knows living it 2 out of 5 years, you get that. I want to talk about scenarios 3, 4, and 5. Split treatment, part lived in, part rented, converting a rental into a residence, and then converting a residence into a rental. So split treatment is when I've got a portion of the property that I live in and a portion that is held for investment or used in a business. I'm speaking to you from my basement. This is what I consider the business part of my property. So I operate my real estate business where I manage investment property out of this, even though it's part of my residence. So my entire basement is used for that. My daughter has a desk. I have a desk. All of the files are down here. So 1/3 of my house is used in a business. The upper 2 levels I live in. There are a lot of different ways. You'll want to get a CPA to do the allocation, but this could be done with a home office. It could be a mother-in-law unit over, let's say, exterior detached garage. It could be a locked off basement. The one that I want to give an example that's easy would be a multiple unit fourplex. You live in one unit, you rent out the other 3. This could apply to a fourplex, a duplex, even a multifamily property. So there are a lot of different variations of this. Where I see a lot of this happening now is with Airbnb. So here's an example here: sale of a fourplex for 800,000. 3 units are rented are 600,000. They're 1031. The 1 unit 200,000 is 121. This investor then can do an exchange out of those 3 units. Another one would be a farmer ranch, right? Here's a large sale price, 4.6 million. The dirt's worth 4 million. The modest farmhouse is worth 600,000, split treatment. So it's another way to accomplish that. You can do one here with an Airbnb, $1 million home, couple units are rented out Airbnb. So 1/5 of this is held for investment. The other portion is the residence. So I just want to give you some different ideas. This one's actually my example here to do that. So lots of different ways to accomplish a split treatment. There's another option out there, which is converting a rental that you exchanged into your residence. And I think this is one that you'll have a lot of in Florida. People buy properties in Florida intending to eventually relocate to the warmer climate, but they're going to go back and forth for a few years. So they do an exchange into a property. Their intent is to hold it for investment. Later on, they can always change their intent. So they decide they want to move into the property. Well, they can certainly do that. They move into the property then. I'll address your question there, Anna Marie, in a second. They move into it. They do have a minimum 5-year holding period. Now, when they go to sell it as a residence, they don't get the full 121 exclusion. They just get a ratio of the amount of time that they lived in it over the total ownership. So I give you an example, I think here. Somebody does an exchange, they rent it for 3 years, they then move into it, live there for 5. They have 8 years of ownership. They get 5/8 of their 121 exclusion on this type of property. Now we got another one, and this one's a great planning opportunity. You can convert a residence. Yeah, I'll give you an example. Residence into a rental. So somebody asked this question earlier. So I have a home that's worth a lot. I have all my equity in it, and I want to convert that into retirement income. So I move out of my home, but because I lived there 2 out of the past 5 years, I still get 121 exclusion. And then I do an exchange into other properties. So here's an example. Somebody bought a residence in San Jose. They purchased it for 300,000. This was 1.8 million. They can carve out 500,000 of gain exclusion, so get it down to 1.3. They move out of it, they rent it out, and then they do a 1031 exchange on that 1.3 million, and they buy a bunch of single family homes in Florida. So lots of different options. Let me go back to the question was up here. Sorry about the cough. Anna Marie, can an owner split a principal? Can a split a principal? What was a personal residence, create a rental unit, and then sell the rental unit as a 1031? Yes, but when they split it, Anne Marie, they have to make sure that they're holding it for investment. So let's say they have a home and they're going to rent out a bedroom and a bathroom to a tenant. They want to rent it for a period of time, ideally a year or more-ish. That portion, the square footage, the bedroom and the bathroom, that portion of their home is now a rental portion, qualifies for a 1031 exchange. So when they sell the house to a buyer, they're going to sell it to one buyer. A portion of it they do an exchange on. The other portion that they live in qualifies for Section 121 exclusion. Karen asks, what is the reverse exchange? Simply, Karen, it's when I buy the new property and I close on it first. Then I have 180 days to sell my existing property. So it's just closing on the purchase before closing on the sale. It's a lot more complicated. There are a whole bunch of moving parts, but we do a lot of these, and we actually at Asset Preservation have a whole division that does nothing but parking arrangements like reverse exchanges. So that's how that's handled. I gave a scenario. Let me kind of wrap up with probably the most important thing to consider, which is doing your due diligence on a qualified intermediary. A lot of people are surprised to find out that the qualified intermediary industry is not regulated at all at the federal level. There's zero federal oversight over qualified intermediaries. Now, there are a handful of states that have state level consumer protection laws. Colorado does that, Nevada, California, Oregon, Washington, Idaho, Connecticut, and Virginia have state level consumer protection laws. You'll notice Florida doesn't. This is the most important issue in any exchange is the security of the proceeds. Unfortunately, we've had some large bankruptcies throughout the years. One was in Las Vegas for $100 million. Another involved 6 different companies. One was in Florida, by the way. Around the country was a $133 million loss, and the biggest loss was $420 million. So you don't need to be concerned about an exchange, but you do need to do due diligence. And what I want to do is give you some questions to ask your qualified intermediary. Now, I happen to believe we come out very, very strong on all these. Number one, does the QI offer customers the written backing of a large creditworthy entity? We are a subsidiary of Stewart, and in fact, Stewart provides at no additional charge a letter of assurance assuring the performance, standing behind the money. So you've now got a company that's been in business for 130 years backing asset preservation, and there's no cap on that. Second one, what's the financial rating? What's the balance rate? What's the balance sheet? Stewart's got a great track record, very conservative company with conservative financials. And then finally, does the QI conduct due diligence on where they're going to invest the money? We only work with the top tier banks and financial institutions. We can't deposit your money in a little local small community bank because it's riskier. We only want to work with the top tier. And in fact, we have a written investment policy that only allows us to work with the top tier banks. So that's really, really critical. I'm looking here at the chat. Joshua, what are the difference in fees to the QI for a standard exchange versus a parking arrangement? Great question. I'll address that. Joshua, we charge on a standard delayed exchange $1,250. You can sell one property and buy up to 3. So $1,250, sell one, buy up to 3 replacement properties. Parking arrangements, typically you're going to start somewhere between $8,000 to $10,000, depending upon the complexity. It's a completely different structure, a lot more moving parts. I didn't get into the details, but your basic exchange is a very nominal fee. If you do a parking arrangement, it's considerably more complex. Getting back here, this is probably the most important question you want to ask. So obviously, I think Stewart and API offer the best security in the industry, hands down, but your QI offers a separate segregated account. What that means is the money goes in, requires your client's signature to open up the account and a corporate officer of asset preservation, and then to move money. You don't want a commingled account. In all of those large bankruptcies, the accounts were commingled. You really need a separate segregated account. Some QIs offer qualified escrow trust accounts. You certainly want to look at their fidelity bond coverage, but the segregated account is hands down the most important aspect. You can find us on social media. You can see us on YouTube, Facebook, LinkedIn, and Twitter. We always have new content we're bringing out. And then finally, to contact us with any question you have, and I've been trying to take them as we've been going along here. Feel free to call us at 800-282-1031 or email info@apiexchange.com. I'll give you my personal toll free and email. It's just my name, Scott at apiexchange.com. My phone number is 888-531-1031. Again, 888-531-1031. And for Hansa and Rima, yes, Stuart's recorded this whole presentation. They will get this out to everybody. Wrapping up, I want to respect your time here and stay on track. I want to keep things on schedule. If you've got questions, call me. I'm happy to do this. As you can see, I've got a lot of experience, and we have a whole staff of people at Asset Preservation that have a lot of experience as well. And then finally, just to mention it, if you haven't worked with Stuart before, give them a shot on your next transaction. And we certainly love to work with you on your next 1031 exchange. And if we're doing it with Stuart, it's all in the same family and we make everything so efficient. So with that, I'm going to wrap up unless there are more questions. And Rhonda, I don't know if you've got any concluding comments you want to jump in with at all.
Hi, Scott. That was great information. I'm sure everybody is, well, as Joshua just said, wow, this was fantastic. Thank you, Scott, for being here. And if anyone else has any questions, drop them in the webinar chat right now. We'll get those answered real quick. If not, like Scott said, we will be sending out the video to everyone. So if you registered, watch your emails and you will get it. Thank you so much for being here. Jesse, Margarita, Christy, thanks for joining us. And Scott, thank you so much. And we'll be doing this webinar again very soon, in a few months, maybe. Sound good, Scott? Everyone
Sounds
seemed to
great.
enjoy it. So, all right. What about the
Thank
slides,
you.
Great.
Scott?
I'll even have my full voice then.
Are you gonna send me your slides too?
Here's what. Yep, I'll send the slides for this on over to you right away. And my last name, somebody asked, Scott Saunders. And just API Exchange, you can find me there as well.
Yep. Or if you have my email or whoever you received the invitation to this webinar, you can always reach out to them and we will get you Scott's information. So we have it in our back pocket ready to give you. So thank you so much for everyone for joining us. And please remember to write Stuart Title in on your next contract. We would appreciate it so much.
Absolutely. Thank you all.
Thank you so much, everyone.
Thank you.
Have a great day.
Bye.